Welcome back for lesson 2. I hope you enjoyed the introduction. This class is going to dive into the meat of order flow. You're going to learn more about market action in this segment than most traders learn in a lifetime from books and trading rooms, and probably more than your economics professor can even get his head around. Don't be scared. It's not complicated. Grab something to take notes with and let's get going. We ended the last section with this chart, candles and moving averages, giving us a visual representation of prices traded over time, in this case, minutes. Lots of information here. But what is this chart not telling us? Well, we can see that price traded here, here, and here. But what I can't see on this chart is how much was traded at any of these prices. This chart's not telling me anything about my competition. How am I supposed to know what a good price to buy or sell for is if I have no idea how many people actually traded at any of these? Was it one person at each price? I doubt it. Is there some area where the majority of trade was made? I have no idea. And risking money without knowing anything about my competition goes against everything we know about Business 101. Imagine this is you and you have a bright idea. You want to open up a coffee shop. What's the first thing you do? Do you spend a whole bunch of money building a coffee shop just anywhere? Maybe you find some cheap land out in an industrial area. Is that a good idea? Well, not unless you want to go broke. So instead, you decide to do some local research. You find an area you like, and you figure out where all the busy coffee shops are currently. You realize that they're all close to several office buildings and a bank. There's great foot traffic in the area, key for a coffee shop, and you realize most of the customers the existing shops are getting are from people walking and biking between these buildings and the retail area the coffee shops are in. Then you notice something. You see an opportunity. There's a busy bookstore and retail space right between the coffee shops and the office building, and there's no coffee shop inside. Well, bingo, X marks the spot. You've found your location because in this business, location is everything. And now those bags of money are right around the corner. Well, trading's all about location too. Let's assume you decide, for whatever reason, to be a buyer at price X. Your hope is that the market will move up to price Z, where you plan to take profit by selling to close. There's that phrase again, sell to close. I'm saying it because you need to remember what's involved in you getting in and out of this trade. Because if you want to buy at price X, don't forget, that means that someone wants to sell here too. The only way you're going to get long is to buy from somebody willing to sell to you. Now, if things don't go your way, you know that down at price Y, you're going to have to be a seller, and you're going to hate it. You don't want to be a seller, but that's your only way to unwind the long. It's called getting stopped out, and it sucks. But that nice lady who sold to you at price X, she'll sure be happy. Now let's assume for a minute that it's not just you who's excited about buying at price X. There's 500 of you, all like-minded, something in the air, I guess. You all want to buy together. And that means what? Well, somebody better be there to sell to you, right? Uh-oh, she's back. But this time, it's not an even match. She's not just selling 500. She's selling 520. And there's not 520 of you waiting to buy. Those other 20 are going to have to be sold at a lower price, someplace where there's another willing buyer. And she doesn't need a big mob of 500 this time. She just needs another 20 willing souls. She's driving the market down to price Y. And what happens to you and your friends at price Y? Well, it's not good. All 500 of you become sellers. Again, not because you want to, but because that's the only way to get out of your long positions. You have to sell to close. So now it's not just her extra 20 pushing the market down. you and your buddies have unleashed a selling spree. And chances are more sellers are going to get excited and join the party. So location is everything. If we know where there's a mob of buyers and sellers, we can track their progress and make informed trading decisions based on their success or failure. So that was a buying example. Let's take a look at this from the other side. Assume a large group of sellers enter the market at price X, and let's call them a cluster. And the market continues lower with some additional sellers coming in. We trade through price Y, and suddenly you get excited. Maybe your moving averages have crossed over and you have your favorite candlestick pattern showing on the chart. You decide to sell at price Z. And it's not just you who's excited. All this downward movement has triggered other indicators, and a whole new cluster of sellers join in. Well, the selling action continues for a bit, but suddenly, like hitting a brick wall, there's a buying effort. Somebody big is coming into the market, trading huge size into the sellers. Another cluster forms, but this time the buyers own it. They drive the market up, but lucky for you, it's just short of your stop out. You're not letting go unless the market reaches price Y. A light selling effort pushes the market back down a little, but then it runs into some more buyers. And it takes a while, but eventually the buyers make another move, right up to price Y. Yep, that's your stop out price. And chances are, with all those other sellers down in that cluster with you, it's probably going to take out more than just you. And what happens when you're short and you need to get out of a position? Yeah, you buy to close. You don't want to be a buyer, but you have no choice. And neither do the other people who sold with you back in that cluster. That little bonfire of stop outs creates even more action, pushing the market higher, looking for sellers to buy into. It pushes right up to price X. That means all those original sellers, the cluster that started everything, they're probably going to start closing out those positions. Nobody likes to turn a winning trade into a loser. To get out, they also have to buy to close. And all that buying sparks a whole new group of traders interested in buying too. Maybe there's even a new moving average crossover in some fantastic candle pattern that gets you excited enough to be a buyer again too. And that new buying excitement, well, it creates a towering inferno. The market explodes to the upside. You see, this is order flow momentum. When new buyers get excited at the same place previous shorts are getting stopped out. And all of it begins with a volume transition. In this case, sellers transitioning into buyers. So how does any of that relate to our chart? Well, for starters, let's get the moving averages off the screen. Now let's zoom in and see if we can make sense of what happened. So here are our prices, X, Y, and Z. We start off with a selling cluster at price X. The market trades down through price Y, and that's when you and all your friends jump into the market, excited about all the downside action. You create another selling cluster. But the buyers come right back and transition through your selling effort with a buying cluster. Now, we don't push all the way up to price Y, so you're not stopped out just yet. There's some light selling, but nothing strong enough to get back through the buying cluster. And some additional buyers start to pick up positions. Again, no heavy action. Then the buyers cluster up again, driving through any selling effort and bumping right into your stop at price Y. That's when the flames start. You and all your friends have to buy to close. And that pushes the market up to price X. And suddenly, that original selling cluster starts unwinding. All the buying gets other traders excited, and the towering inferno is now blazing. Well, here's a question. That all sounds really smart, but how do you know that there were clusters of volume where I said they were? It's not like you can see them on this chart. That's because candle charts only show the open, high, low, and close. That's it. Write that down. Candles only show the open, high, low, and close, with literally thousands and thousands of trades happening. For some reason, people like to use charts that only show 4 data points. It's like looking at an old analog TV. It might have been a nice TV back in 1992, but technology changes. I'm pretty happy with my 4K flat screen. I'm not going back to the 90s for my entertainment, and I certainly can't imagine using 1990s technology for trading. So what's the solution? Well, first, let's make some changes to the chart. I'm going to strip the body color out of these candles. We can use the wicks for color coding, so there's no need to panic. We still have green for advances and red for declines. And the next thing we're going to do is add a little more data. See all these little gray spots in the candles? This is showing us the point of control, or POC, of each period. The POC is the single price in a period at which the most volume traded, the heaviest weight, if you will, or what some people call the most fair price. It's the price where the most buyers and sellers came together to do business. And that means it's also the price that once we move away from, is going to make the most people get stopped out. And finally, we're going to add a little more definition, like HD instead of standard def. Instead of just the point of control, we're going to look at clusters of volume. That means instead of just a single price, the point of control, we're now able to see the consecutive prices which hold the highest concentration of volume in any period. And you might have noticed they're color-coded too. Green clusters show prices where buyers dominated the exchange. Red indicates sellers were in control. And gray shows clusters which were generally neutral, not strong enough to force a substantial move in the market. So when we zoom in on our low, we can see the selling clusters, followed by the buying transition, and the additional buying that formed more buying clusters, which started the fire that we've all come to know as the towering inferno. That is the what, how, and why of this chart. Now it's time to demonstrate it slowly. Let's begin by watching the selling cluster form as the market appears to be breaking down. You'll notice that most of the selling is located at the low of the period, and we can see the buyers attempt to fight back up through the first cluster. Eventually, they give up, allowing the sellers to carry price lower. Next, we're going to see the buyers come back in off the low. They're strong enough to trade right back into the selling effort, bouncing a few times before penetrating the entire cluster. This is the key volume transition that creates the momentum later in the chart. Now notice how we rotate back into the transition, allowing more buyers to follow through. The price action really tells a story here. Next, we're going to look at the forced stop run. We can see the selling cluster at the bottom of the chart. That's our key transition. But focus now on the buying effort once we start to challenge those middle highs. This new buying cluster is forcing the sellers out of their positions, forcing them to buy to close. Don't forget about the original sellers at the high. We're now moving into their positions. As that selling effort transitions, we see new clusters forming. Sellers trying to stop the upward action, outnumbered by new buyers excited about buying, and the buy to close orders triggered from the traders letting go of their shorts. And while I'm not a proponent of moving averages, I think it's only fair to show what happens when OFA is combined with regular technical analysis. I'll show you a very specific reason in the next class why I wasn't trying to sell here, but let's watch the moving average trigger the sellers who found themselves stuck upside down, right here. See the cross? I'm going to fast forward through the move lower, as you've seen it a few times now, but watch this next period, how the buyers try to lift back up through the last selling cluster and eventually give up. That's the natural movement of the market as clusters form, something we can't see on a static screenshot. Even though this didn't work out for the sellers, and not all trades will work out, what's fantastic about this chart compared to regular candles is you can see exactly when the short fails. There's no reason to wait for price Y like we used in the examples today. The second we see the buyers transition back through the selling cluster, any OFA trader would have known to go flat. At a loss? Sure, maybe a couple of ticks. Compare that to the traders who went upside down, waiting on the moving average for a reverse. I'm going to speed the playback up again while we move up towards the final breakout cluster, but I'll take a minute here to get you excited about the next lesson. In class 1, I told you that the results of basic candlestick patterns could be drastically improved. Drastically. That was my description. Well, I want you to take a look at the 3 candles that have formed down at our transition. Do you notice how all 3 of them sort of have clusters that are overlapping one another? Now look at this last little move back down against those clusters. The sellers couldn't break back through the transition. It's like a wall. We're going to zero in on exactly how to trade off of situations like this. And you're going to discover the key to finding perfect entries in any market. We're taking candle patterns to the next level. No more analog TV from the 1990s. We're trading 4K HD here at OFA. All right, the buyers are about to come back in, and I promise this is the last time we'll be looking at these moving averages. So here comes the breakout cluster. This is where the selling cluster from the low actually gets stopped out, and new buyers start getting excited, driving the market up to new highs. I hope you enjoyed today's class. Section 3 will focus on combining clusters of trade, which allows us to pinpoint entries, find perfect targets, and keep the stop outs to just a few ticks.